There's this persistent story in the financial world, and honestly, just in casual conversation, that the shopping mall is basically a graveyard.
Right. We all kind of have that mental image.
Totally. We walk past these legacy storefronts, maybe grab a pretzel, and just assume these brands are dinosaurs waiting for the asteroid.
But every once in a while, you get a data set that just completely flips that script.
It creates a lot of cognitive dissonance, doesn't it? We assume old means dying.
Exactly. And that's why we're talking about Victoria's Secret & Co. today, or VSCO.
Because looking at this new research, the story isn't about extinction anymore.
No, it's about a very complex, very high-stakes evolution. It's arguably one of the most interesting turnaround experiments happening in public markets right now.
Right, because this is a massive, iconic brand that, let's be honest, completely misread the cultural room for a few years.
Oh, they lost their way. Badly. But this new data suggests they aren't just surviving. They're figuring out how to thrive in what analysts are calling a post-promotional world.
Post-promotional. That is a very corporate way of saying we stopped putting everything on the clearance rack, isn't it?
That is exactly what it means. And for a shareholder or, anyone interested in business strategy, that is the holy grail.
That means you have pricing power.
You have pricing power.
So here's our mission for this deep dive.
Yeah.
We're looking at a brand new research report from CompassScope, dated January 26, 2026. So this is fresh off the press. And we're layering that with the company's Q3 2025 earnings transcript. We need to answer a single question. Is the new era of sexy, as they call it, actually a viable business model?
Or is it just a marketing slogan to make us feel better about the past?
Exactly.
To answer that, we really have to look under the hood. We're going to dissect the business model, the competitors, the strategy, and the actual financial quality of this turnaround.
Let's start with the basics, because I think most people just hear Victoria's Secret and think lingerie. That's it.
Right.
But the CompassScope report shows the business is structured a bit more distinctly. It's not just one big blob of lace.
No, and if you treat it as one blob, you miss the entire investment thesis. You have to view VSCO as three distinct engines.
Okay, three engines.
First, you have the Victoria's Secret brand. This is the mothership. It's targeted at adults.
This is the core bra authority, the intimates, sleepwear.
Exactly. It's the foundation. Then you have the second engine, kink.
Right. And pink is different.
Very distinct. It targets women aged 18 to 24. It's much more lifestyle oriented. Think collegiate hoodies, sweatpants, things you wear to class.
It's serving a totally different psychological need. Less glamour, more comfort.
More community and comfort. Yeah.
And the third engine. This is the one that always surprises me when I look at the numbers.
Beauty.
Yeah, beauty. I think for the average consumer, the perfumes and mists feel like impulse buys at the checkout counter.
Like an afterthought.
Exactly. You're waiting in line, you grab a rollerball. But is it actually meaningful to the bottom line?
It's incredibly meaningful. For the CFO, beauty is a profit machine. We're talking fine fragrances, body mists, lotions.
And now candles, I see.
And now they've pushed into home fragrance with candles. But here's why investors love it. The margins.
Ah, okay.
The profit margin on a bottle of fragrance is generally much, much higher than on a garment that requires complex stitching and fitting. It's a halo for the brand that just generates cash.
So it's the cash cow in the corner, funding everything else.
Pretty much.
Now, geographically, is this machine running the same way all over the world? Like if I walk into a VS in Shanghai, is it the same business model as one in Ohio?
Visually, maybe, but financially, no. And this is a really critical distinction for risk management. In North America, they own the stores, the leases.
The whole operation.
They own the retail and digital channels. They pay the staff. They hold the inventory.
High risk, high reward.
Precisely. But internationally, we're talking China, Europe, the Middle East. They've pivoted to a partner-led model.
Good, like franchises.
Essentially, it's an asset-light model. Instead of VSCO paying the crazy rent on a flagship store in Paris and taking the risk on inventory.
A partner does that.
A partner does that. VSCO just collects royalties and wholesale revenue. It decouples their international growth from their own capital spending.
That's smart. It limits the downside. Okay, but let's talk about the market right here at home, because it feels so incredibly crowded.
It is.
You can buy underwear anywhere now. Who is VSCO actually fighting?
The Compass Scope report is fascinating here because it breaks the war down into specific battles. They aren't fighting everyone the same way.
Okay.
First, you have the mass battle. This is against players like, say, Hanes brands or the stuff you buy in a multi-pack at a big box
The
store.
commodity stuff, the basics you buy because you need them, not because you want them.
Right. And in this battle, VSCO wins on brand desirability. They aren't selling cotton, they're selling an emotion.
And that gives them pricing power.
It gives them pricing power. Hanes can't charge $60 for a bra easily. VSCO can.
Okay, but what about the lifestyle battle? I'm thinking of Aerie. They've been the thorn in Victoria's Secret's side for a decade now.
That's the biggest direct threat.
It feels like a harder fight.
It is a harder fight. But the report notes a shift. Aerie is very trend-dependent. They ride these waves of fashion.
Right.
VSCO is leveraging what they call fit authority. They're leaning into the fact that they have the scale and the technical expertise that Aerie lacks.
Yeah.
They're positioning themselves as the experts, the engineers of the category.
The engineers, not just the cool kids.
Yeah.
Interesting.
Yeah. Then you have the premium sport battle.
Lululemon.
Lululemon. I mean, let's be real. Lululemon wins on pure performance. If you're running a marathon, you're probably buying Lulu.
Sure.
But VSCO wins on use case.
What does that mean? Use case.
It means versatility. You don't typically wear your high-impact Lululemon bra on a date.
Okay.
VSCO covers the entire spectrum: sexy, everyday, sleep, and sport. They own the drawer, not just the gym bag.
Okay, here's the one I really want to dig into because it's the narrative we've heard for years. The digital natives, the Third Loves, the Savage X Fenties, the brands that were supposed to kill them all. Why are we still talking about VSCO if the internet was supposed to replace them?
This is where the story has completely flipped. 5 years ago, the headline was, DTC is the future. But look at the economics today.
It's expensive.
Customer acquisition costs CAC have skyrocketed. It's incredibly expensive to buy ads on Instagram or TikTok just to get one new customer.
So the digital brands are just burning cash to your eyeball.
A fortune. Meanwhile, VSCO has the omnichannel advantage. They have the physical stores. You can walk in, get measured by an expert, try it on.
That physical presence, which we thought was a liability, is now a defensive moat.
It's a massive moat against the digital startups who can't afford to build 800 stores.
And what about Shein, the fast fashion monster? Why can't Shein just clone the Victoria's Secret bra and sell it for $5?
The report makes a great point here. It is very, very hard to fast fashion a technical bra.
Because of the engineering.
Exactly.
Yeah.
A t-shirt is easy.
Yeah.
A bra has 30, 40 components. It has wires, different fabrics, tension, stretch, clasps. It has to fit perfectly or it's painful. VSCO's fit expertise is a shield. You just can't replicate that quality at a $5 price point. It will fall apart.
So they've got this category leadership, this fit authority, the beauty business pumping out cash. That sounds stable.
It does.
But stability isn't growth. Investors want up and to the right. So how do they actually plan to get bigger?
That's the pivot point. They're moving from fixing to building. The strategy is what they call multi-vector, and importantly, it's internally funded.
So they're not just buying other companies to fake growth.
Nope. This is about fixing the core. The Compass Scope report calls it the path to potential.
Okay, let's walk through the pillars. What's the first bet?
Pillar 1 is supercharge bra authority. This goes right back to that engineering moat. They are doubling down on innovation and fit across every lifestyle.
Win the bra, win the customer.
That's the idea. Win their trust. Pillar 2 is reposition pink.
This is crucial because pink was drifting.
It really was. They're trying to restore it as a lifestyle brand for that 18 to 24 demographic, but with a heavier focus on apparel. They want to be the uniform for Gen Z.
Which is a tough crowd to please.
Yeah.
Gen Z smells inauthenticity from a mile away.
The toughest. But Pillar 3 has the easiest math. Fuel beauty. They have a domestic base of nearly $1 billion in this category.
And the frequency is higher. You run out of body lotion way faster than you wear out a bra.
Exactly. It drives traffic, it lifts margins. And finally, Pillar 4 is international expansion using that partner model with a specific focus on China.
Okay, there's a financial term in the report I want to unpack. Operating leverage. What does that mean in the context of selling lingerie?
Sure. So think about a physical store. You have to pay the rent, the electricity, the staff, whether you sell 1 bra or 1,000. Those are fixed costs.
Got it.
Operating leverage means that as your sales go up, your costs don't go up at the same rate.
So the cost to sell the 100th bra is way lower than the cost to sell the first one.
Exactly. Once you cover the rent, every extra dollar of sales drops almost entirely to the bottom line as profit. That's the goal.
That all sounds great on a PowerPoint slide, but life is messy. What's the reality check? Where does this fall apart?
Well, the report rates the execution risk as moderate. So, not bad, but not safe either. The biggest danger is something they call brand heat dependence.
Brand heat. That sounds so intangible. How do you even measure that?
It is intangible, and that's why it's risky. The whole model relies on being culturally relevant. Are you cool? Do people care about your fashion show?
If that heat fades,
If the heat fades, the only lever you have left to move product is price.
you have to put out the sale sign.
And once you go back to discounting, it's incredibly difficult to wean customers off of it. It's like a drug. So that promotional discipline is a huge risk factor.
And I imagine supply chains are still a headache.
Always. Tariff exposure is a big one. If it costs more to bring the goods in because of trade policy, that eats right into the profit they're trying to build.
Okay, so let's look at the scoreboard. We've got the theory. Now for the reality. We have the Q3 2025 earnings transcript. How did they actually do?
In short, they beat expectations significantly. Net sales were $1.47 billion, up 9% versus the previous year.
Okay, 9% is solid.
But the real story is the profitability. Adjusted gross margin was up 170 basis points. Earnings were up 45%.
Wait, 45% earnings growth?
45%. It's
Yeah.
massive. It shows that operating leverage we just talked about is actually kicking in.
And what about market share? Because for a while the story was they were just bleeding share to everyone.
They gained over 1% share in the U.S. intimates market. Now, 1% might sound small to you,
It does sound a little small.
but you have to remember the overall intimates market was actually declining. The pie got smaller.
So grabbing 1% more of a shrinking pie means they're eating someone else's lunch.
They are eating someone else's lunch. It's a huge win in a tough environment.
So what drove it? Was it just better products? Marketing?
It was cultural relevance. The return of the fashion show was the catalyst.
I remember seeing clips of that. It felt different than the old days. Less exclusive.
It was tailored for the modern era, but it brought back the glamour. And the numbers back that up. 61 million streaming views, up 60% year over year.
Wow.
42 billion media impressions. But here's the key. This is what investors care about. It wasn't just buzz, it converted.
People watched the show and then actually bought the product.
Immediately. The very sexy and glamour lines accelerated right after the show. And for Pink, they saw double-digit sales growth.
Pink growing double digits feels like the headline here. I thought that brand was on life support.
It was really struggling. But they leaned hard into collaborations. Love Shack Fancy was a big one, and pop culture. They had the K-pop group Twice perform.
K-pop is basically a cheat code for engagement right now.
It works. The Wear Everywhere bra that Twice wore sparked a massive sales spike. Pink intimates returned to growth for the first time in years.
So here's the skeptical question. When I see sales go up, I always ask, are they just moving volume because they slash prices?
That is the aha moment of this whole report. And the answer is no.
Really?
AUR, average unit retail, the actual price the customer pays, was up 3%. And if you exclude panties, which are lower priced, AUR was up 6%.
So they sold more items at a higher average price.
That's the dream scenario. That proves the brand heat is real. They didn't have to bribe the customer to shop.
And who is this customer? Is it just the old loyalists coming back?
The customer file is growing for the first time in a while, and the demographics are really promising. The growth is being driven by 18 to 34-year-olds.
Yeah, Target.
It is. And the CEO made a specific point that the acquisition is coming from brand heat, not deal heat.
Not deal heat. I like that phrase.
All right. People are walking in with pictures from Instagram on their phone saying, I want this specific look, not where's the clearance bin?
Yeah.
It's a fundamental shift.
Okay, so 2025 ended on a high note. As we look into 2026, what are the landmines? What does CompassGo say we need to watch?
They rank the uncertainties. Number one is the sustainability of brand momentum. You can't have a massive fashion show every month.
It's too expensive and the novelty wears off.
Exactly. Can they keep this energy up in February and March and April without the fireworks?
Can they drive traffic on a regular Tuesday?
That's the question. Number two is those tariffs we mentioned. They expect a roughly $65 million impact in Q4 2025 alone.
That is a big bill. $65 million is not a rounding error.
It's not. They're trying to mitigate it by, diversifying where they source from, but it's a headwind. It just makes everything more expensive.
And the macroeconomy, the consumer.
Always a factor. The report lists it as a key uncertainty. Will consumers pull back post-holiday? If people stop spending, a $60 bra is often one of the first things to get cut from the budget.
And what about pink? Can they keep the cool kids interested?
That's the pink durability risk. Gen Z is fickle. They love you today, they cancel you tomorrow. Can they keep them engaged beyond this trend cycle?
And then there's the upside, the beauty opportunity we touched on.
This is the stat that stuck with me, and I think it's the hidden gem in the report. Currently, only 40% of their customers shop the beauty category.
Wait, hold on. So 60% of people walk in, buy a bra or pajamas, and walk right past the perfumes and lotions.
Exactly, and that is a massive opportunity. We call it share of wallet. You already have the customer in the store.
You don't have to pay to acquire them.
You don't. If you can get that bra shopper to just pick up a candle or a body mist on the way out, that is pure high-margin growth.
So to wrap this up, it really sounds like VSCO has transitioned from a fix-it project to a genuine growth story.
I think they have. They've proven they can hike prices and grow volume at the same time, which is just so rare in retail.
It really challenges that whole mall is dead narrative.
It shows that just because a brand is old doesn't mean it can't learn new tricks, or in this case, new fits. And the data shows the new era of sexy isn't just PR spin.
It's a viable, profitable business model.
It is.
Here's a final thought for you to chew on, and it goes right back to that beauty stat. The company says beauty is their second most valuable customer category, yet 60% of their shoppers don't even touch it.
Right.
We think of Victoria's Secret as a lingerie company that sells some perfume on the side. But if they unlock that cross-sell, does this lingerie company actually become a beauty giant in disguise?
That is the billion-dollar question. If they crack that code, the valuation of this company looks very, very different in 5 years.
Something to think about next time you walk past that pink storefront.
Hmm.
That's it for this deep dive into Victoria's Secret & Co. Thanks for listening, and we'll catch you on the next one.
This content is produced by compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on compasscope.com.